Welcome to Chapter 7 on Financial Planning. Pricing the package. In this chapter, we'll delve into the crucial topic of pricing the package. A sound understanding of financial management is indispensable for tour operators. While we won't cover the basics of accounting, we'll explore how financial considerations impact pricing strategies and overall profitability. Setting the right price for a holiday package is no simple task. Operators need to consider factors like advance payments, cash flow management, currency exchange rates, and competitive pricing. These elements intricately shape the final price, ensuring both profitability and customer appeal. For tour operators, the price of a holiday package isn't just income. It's the core revenue source. Customers, on the other hand, evaluate packages based on factors like their finances, alternatives, and constraints. Price is a pivotal factor in their decision-making process, acting as a signal of quality and accessibility, especially since bookings are made well in advance. Crafting an attractive package involves offering value that surpasses individual components. Setting the optimal price entails strategic planning that aligns with company objectives, covers costs, manages cash flow, and adapts to market dynamics. Let's explore some essential aspects further. First, operating costs. Before determining the price of a package, operators must consider operating costs, profit margins, and distribution expenses. Costs can be complex due to the multitude of components in packages. The actual profit earned by operators is influenced by their operating cost. Fixed costs such as advertising and rent remain constant regardless of the number of passengers. Variable costs fluctuate based on business achieved, like ad hoc accommodation bookings. Second, operational costs. While operators aim for competitive pricing, there are additional expenses that must be factored in, like air taxes imposed by governments and charges related to airport departures and landings. Third, load factor. Operators anticipate that not all seats or accommodations will be sold. Let's take an example. A flight with a cost of $5,000 and 100 seats available might assume a load factor of 90%, meaning 90 seats will be sold. So the cost per seat becomes around $55. Lowering the load factor, say to 80%, would raise the price to $62.50. High load factors are preferred, but they also pose risks if sales targets aren't met. Fourth, empty leg. When chartering planes, operators consider empty legs, which means flights where no passengers are carried. Finally, distribution costs. Distribution costs come into play as well, including travel agent commissions. Commission structures and pricing considerations can be intricate, impacting overall costs. Commission is pivotal in distribution. Travel agents typically receive around 10% of the selling price. This impacts the overall price calculation. For example, if a holiday costs $317 and the travel agent receives 10% commission, the operator must add roughly $35 to $36 to the cost, along with a markup for fixed costs. This determines the final price, often referred to as the break-even point. Tour operators can publish this package, $399 selling price. Seasonality and forecasting. Seasonal pricing is a common strategy, with prices varying based on demand. For instance, a holiday priced at $399 in low season might increase to $499 in high season. Supply contracts also play a role. Some components like hotel prices may fluctuate seasonally, affecting package costs. Forecasting and capacity management. Accurate forecasting of costs and sales is crucial. Operators must predict demand and adjust pricing accordingly to avoid unsold inventory. The adoption of yield management systems allows operators to change prices based on demand, aiming to overcome late bookings, unsold capacity, and achieve optimal pricing. Mass market and specialist operators have different approaches to their pricing. Mass market operators frequently use price fluctuations and last-minute deals. Strategies include increasing prices closer to departure, rarely used due to competition. You increasing prices closer to departure creates customer expectations, and optimizing prices daily using yield management systems. Specialist operators, however, often prioritize consistent pricing due to group dynamics. Instead of dynamic pricing, they might increase capacity while maintaining the same price, ensuring a satisfying customer experience. This concludes part 1 of chapter 7. In the upcoming part 2, we'll delve deeper into pricing strategies and tactics employed by tour operators to set the right price for their products, enhancing their competitiveness in the market. See you in the next video.